Good afternoon. Happy Friday, May 9th. Mark Milam here, your mortgage professional. Let's talk about the week. So, relatively calm week. We saw interest rates worsen just a little bit. We did have the Fed meeting this week on Wednesday, 2 p.m. The Fed updated its rate policy and did what everyone expected it would do, which was absolutely nothing. It did not alter the Fed funds rate one way or another. Let's first talk about the week that was. So, these are the past 5 business days right here. We can see this is Friday here, relatively calm day in the market. Yesterday, not so great. It was a big sell-off in the market. This is really all around economic data that's proving to be resilient, particularly in the labor market. And I'll scroll down the screen and show you what I'm talking about. This is yesterday, May the 8th, and you can see weekly jobless claims coming in a little under expectations. That's really not the big mover. What was a big mover was labor costs. Labor costs going up. And that's not what we want to see in an environment where we're looking for more deflation. We're trying to get inflation down back to the Fed's target rate of 2%. We don't want to see a resurgence of inflation. Doesn't particularly help us when we see labor costs go up. Also doesn't help us when we hear that the Fed is going to hold rates steady as it's concerned about, here's the S word, stagflation. Stagflation, this phenomenon where we have rising inflation with reduced output. And so the Fed has been holding the Fed funds rate steady, trying to ensure that the Fed doesn't repeat the mistakes of Arthur Burns back in 1978, where Arthur Burns cut the Fed funds rate too quickly. It reignited inflation, what we call boomerang inflation, and off we went into an even worse cycle than the one we had just come out of. It took a new Fed chairman, Paul Volcker, to drive up interest rates, force the country into recession, a pretty steep recession, to reset the economy. This is where you get all of those tales from our parents and our parents' parents about interest rates being at 18 or 20%. We don't want a resurgence of that. The Fed does not want to get fooled again, and so they're going to hold the Fed funds rate higher for longer to ensure inflation's defeated and we don't wind up with something called stagflation. As we move through that, let's take a quick look here at the Fed funds futures. So this is what traders think is going to happen, and we're going to zoom out now to the June 18th meeting. That is the next meeting on the horizon. Listen, if we go back about a month ago, it was roughly 60% chance that the Fed was going to cut the Fed funds rate by a quarter of a point on the June 18th meeting. Fast forward to today, we're now looking at an 83% chance they're not going to do anything, that they're going to keep the Fed funds rate steady through the June meeting, and we won't have another meeting now until July. So easily the first half of 2025 looking like we're going to see zero change to the Fed funds rate. That's not at all what anyone was anticipating when we started the year. We thought inflation would be under control and the Fed would begin cutting. But with the tariff uncertainty, are we going to have these jumbo-sized tariffs on China or are we not? Are we going to have tariffs with all of these other countries? With all of that uncertainty and exactly how it's going to impact our market, as well as the resilience of the economic data that we're seeing, the Fed just not comfortable cutting the Fed funds rate. And honestly, from a mortgage rate perspective, I kind of shrug my shoulders at this and say, who cares? The Fed doesn't really set mortgage rates anyway. In fact, of late, when the Fed does choose to cut the Fed funds rate, we don't see mortgage rates improved. I'm going to take you back to the days of September of 2024, and this is the 30-year fixed mortgage rate here, this blue line, and down here, this red line is the Fed funds rate. And you can see when the Fed began cutting in September of 2024, what did the 30-year fix do? It rose sharply, right? It rose sharply there in September and October, rose again in November, and we're seeing interest rates back above sevens. That cutting of the Fed funds rate is really just a short-term overnight lending rate to banks and financial institutions. The 30-year fixed is much more impacted by the 10-year Treasury. Those are market-driven rates. You don't dial those in like you do the Fed funds rate. It's really dependent upon the market, and the bond market flatly issued a rejection, a vote of no confidence for the Federal Reserve when they were cutting the Fed funds rate back in September, basically saying, hey, you haven't put the genie back in the bottle yet, and you're cutting too much too soon. So ultimately, I don't think it would be great news for the Fed to be cutting the Fed funds rate, at least as it pertains to mortgages and housing affordability. We'll keep our eye on the ball as we move towards June and the next Fed meeting and then out into the end of July for the subsequent meeting. If I can be of any service to you over the weekend, don't hesitate to reach out. Mark.Milam at highlandmtg.com. Have a good weekend.